Good day there, Wealth Press traders, subscribers, investors. Welcome to another Market Weekly Wrap-Up, and I'm joined as usual by Roger Scott. Roger, how are you doing today?
I'm doing great. It's a Friday, and James, thank you for having me out here. I appreciate it.
Sure, you bet, Roger. The markets are demonstrating a bit of a recovery mode today, and the sentiment in the market seems to be on the upswing thanks to the increased dialogue around the potential for stimulus. What's their summary for the week's activity, and where are we heading into these last 2 weeks before the election?
Well, all good questions. To be quite honest with you, I'm not seeing the market's recovery as bullish as a lot of traders out there. Why? Because I'm looking at momentum levels. Momentum levels on the Nasdaq, and this is the 50-day. I won't even go into the 200-day. They're just way overbought. But if you look at the number of stocks in the S&P and the Nasdaq, the highs are getting lower, and the number of stocks trading above the 50-day moving average is slowly declining. Now, there's a few positives. The positive is the market is becoming, the strength in the market is becoming broader, a lot broader. In other words, several months ago, a quarter ago, 2 quarters ago, it was very, very driven by large cap, stay-at-home tech and healthcare. Right now, you're seeing a lot more industrial, basic material, consumer discretionary, retail stocks. So that's favorable. But what I'm seeing in terms of momentum levels is bothering me, more so in the NASDAQ 100 than in the S&P 500. But overall, I think the market is going to be in a very, very restrictive pattern, so to speak, till the election. Volume right now is down. There's about 30-40% less interest in the market. So my suggestion for traders out there is to just hunker down and be prepared for a whole bunch of nothing for the next few weeks. For the most part, you're still going to see momentum in a select few stay-at-home stocks. I mentioned Peloton last Friday. It was $115. It's at $136 right now. Some of my stocks have been doing very, very well, but as far as the broad market is concerned, we have to be cautious. Not really bearish, but cautious till the election. Also, you got to keep in mind right now, and I try to tell this to a lot of people, the election is not going to have as big of an impact on the market as people think, partly because this COVID-19 climate has created a specific kind of like a domino effect, or a butterfly effect, if you want to call it. And I think this is going to be with us for the foreseeable future. And ultimately, the central banks, the Fed, and COVID-19 and the vaccine surrounding it are going to be driving or shaping the flow of this market for the foreseeable future, not the presidential election.
Mm-hmm. Okay, and so with that in mind, I mean, is it advisable then for the retail investor to essentially observe what's going on from the sideline? Should they be deploying capital in a very judicious, selective way, or what is the right course of action for these last 2 weeks before the election?
Well, as you and I know, you and I are not financial advisors, but in opinion only, my suggestion, if it was me, what I would do would be, I would reduce my exposure to about 15 to 20%. Or if I was not willing to do that, if I didn't want to reduce my exposure, there's alternatives. Roll your cash or your equities, liquidate the equities, roll them into defensive ETFs or ETFs that are very diversified, and or create a portfolio that has a hedge. So if you want to be a cowboy, if you want to be all in, and make sure you're not 150% long. Make sure that if you're going to go long some stocks, make sure you have specific stocks that are bearish to offset that risk. I think right now, the key right now is not to think about how much money you can make in the markets. I think the key right now is not to lose what you have. I think preservation of capital and defensive course of action is the key till after the election. I think to give people at home a really good analogy for people who are not professionals out there, I think a really good analogy would be, think of right now as the last 2 weeks of August. typically. Now, usually before the election, summers are fairly busy because hedge funds realize that the fall is going to be fairly subdued, so they start making their moves before. We saw that last election. But typically, generally speaking, outside of the election, people are not thinking about the stock market the last 2 weeks of August. That's the climate we're in right now.
Okay. I noticed that reports about the retail sector indicate that consumers have showed some unexpected uptick in their discretionary income. They're more active. Do you think that the advice of Dr. Fauci to rethink their Thanksgiving plans and that kind of sentiment as a result of the coronavirus is going to have a very uplifting effect on the whole online retail sector that might present an opportunity?
Yes, I think that's going to be a big opportunity. I think we're going to see, I think there's going to be several things, but they're all leading to the same direction or the path that you're guiding us along on right now, James. Here's how I'm looking at it, okay? And again, let me just kind of take a backdoor, kind of a side detour into answering your question, but I think this is important, and I think this makes a whole lot of sense. Whether you go door A or door B, whether you take path A or path B, in other words, whether you think that COVID is going to rear its ugly head or not, I think we're still going to have the same type of trading action, which will benefit the type of stocks that you're talking about, the stay-at-home stocks and the online shopping. So yes, I think the online trend is only going to increase. It's showing remarkable strength. And I think online retailers or brick and mortar retailers that have done a reasonably good job of switching online, like Target, Walmart, Apple, and Best Buy, Gap, L Brands, and several others. I think they're going to do really, really well. But here's the thing. Regardless, I think, and this is something Jeff Zenninari and I have been talking about, I think a lot of people have this unexpected belief because this has never happened before in our lifetime. You know, this COVID-19 no one just snapped their fingers one day and said, COVID-19 is here, we're all screwed. Nobody did that. And it's not going to be the same way coming out of this. It's not going to be a binary thing. People are not computers. People are not based on math. There's a lot of things. There's a lot of stuff involved. For example, one drug is going to come out with a vaccine. The vaccine is not going to work on everybody. Another drug is going to come out. There's going to be cocktails. There's going to be this. There's going to be that. It's going to be a process. According to, let me just not go very far from the topic. I'll stick to the topic. According to many analysts, including Bank of America, this thing that we have, the stay-at-home climate that we're in, this COVID climate, it has created a fast-forward climate for stay-at-home and technology and all of these things that we're talking to a tune of $2 trillion. And it has created a fast-forward machine, James, that has brought us to the future 4 to 5 years as of right now. Okay? So what you're seeing in Zoom, what you're seeing in Peloton, what you're seeing in how people are using computers, we're not in 2020 anymore. We're in 2024, 2025 right now. This is according to analysts, Bank of America. This isn't some kid, writing on the internet. This is serious stuff. They're putting millions and millions of dollars into this research. They're giving real numbers behind us. But I'm going to add something. It's not just the online buying. What we're now seeing is we're seeing the same type of frenzy moving into traditional retailers. For example, shoe companies, okay? I was doing a spotlight on this yesterday. Crocs, Decker, Nike, all these three companies I just mentioned, they're all at all-time highs. Do you know why? Because this new stay-at-home environment is now being changed to stay away from me environment. Let me do what I want outside. I want to go hiking. I want to go. So those companies are seeing a huge, huge influx of buying. The last 3 pairs of shoes I bought online. I just bought a pair of Hoka shoes, which are made by Decker. Very, very hot shoes. It is what it is. It's a very hot shoe brand. They make sandals, but these 3 shoe brands are going nuts. They have nothing to do with technology, but it's a lot of people, it's not just about technology anymore. And this is what I mean. The stay-at-home market is becoming broader. It's not limited to just technology and healthcare like it was in February. I have this cool little thing. I have a time machine indicator, and it tells me my highest relative strength stocks compared to 3 months ago. And if you look at the stocks that were the top 20 or 30 a few months back, it was mostly tech and healthcare. If you look now, you've got freight shippers, you've got the shoe stocks the shoe manufacturing stocks I'm talking about. You got Whirlpool, you got residential home builders. It's a lot broader. So I think what we have to do is we have to redefine the environment a lot. It's become broader. It's still limited to very specific sectors, but those sectors have become a lot broader because people are starting to live their life in a different way and take advantage and kind of try to maneuver through this environment that we're in right now.
You bet. You bet. Okay, so Carmen Reinhart, in comments today to the World Bank, suggested that, well, she's the World Bank price economist in charge. She suggested that we are going to emerge from the coronavirus pandemic into a financial crisis. And I look at that sort of sentiment and think, well, that's kind of scary coming from the head of the World Bank, especially given that it's the opposite of what we want to hear or how we want to feel going forward, coming out of the pandemic. The last thing we want to do is hop out of the frying pan and into the fire. What do you think of that sentiment?
I think it's an opinion. And here's the thing. We truly don't know where we're going to end up. And here's the bigger problem, which what they may be talking about, what the central bank may be talking about, or the Fed may be talking about, or the head of the world, these heads, they may be looking at the bottom line. You see, they may be, and the truth is, I mean, look, the U.S. has been going into a higher deficit and a higher deficit every quarter, almost by a record amount, right? You and I have been talking about it since day one, and the stock market continues to make new highs. So I think you have to kind of look at you have to kind of separate the hard numbers from the representation of what people are doing and what people are reflecting in the future of the economy. So I think we have to kind of look at that, where they may be right and the stock market may still be near all-time highs, which historically we haven't seen, but we're starting to see, as you've pointed out many, many times, we're starting to see a much wider spread between reality and the stock market. You would agree with that?
Absolutely.
Absolutely. Right. So if you were, let me ask you this question. Let's say you look at what was the name of the person? Because I don't want to refer to them by their name. Do you?
Dr. Carmen Reinhart.
Reinhart. Okay.
Yeah, she's the chief economist of the World Bank.
What if Reinhart was just looking at the balance sheet and the economy and was not privy to the stock market? She might have a very good point already. You see
I can't agree with you more. I mean, that's what I thought. I said, well, she's obviously referring to the economy, and in our current state of reality, the economy has nothing to do with the stock market. In fact, a financial crisis in the broader economy only will point to emerging and isolated opportunities in the stock market.
Right. Exactly. So she could be right, but also, again, in my opinion, the level of, and I'm going to talk about the stock market. I'm not going to talk about the economy. I think as far as the economy, we're in a very bad place, but we've been there for so long. It's just, I'm a trader. I'm into the stock market. So we got to separate the two. And we don't know exactly if she's only talking about one or she's looking at the other. Traditionally, traditional economists have not involved the stock market in their shenanigans, so to speak. They've pretty much stuck to the books. So I sort of agree with her, James. I don't see any other way for the economy. But the stock market's a different story. Look at all the cash, the influx of capital, the central banks and the Fed have put in. Look, I tell this, I show people two graphs, two time periods. I started in 2008 and I show them between 2008 and 2020. In 2008, the global stock market was worth $30 trillion. Okay. In 2000, let's see, 8 years. In 2016 in 2014, the stock market was worth $70 trillion, from 30 trillion to 70 trillion in 6 years. Okay.
Yeah.
From 2014, when the Fed stopped putting money into the economy, to 2020, how much did the stock market grow? $2 trillion. So when central banks, the moral of the story is this: central banks and Fed putting money into the economy, global stock market doubles in value. 6-year period. Next 6-year period, the Fed don't put anything into into the economy. The stock market doesn't do anything. What's the Fed doing now? They're putting more money into the economy than we've ever seen before, and more than 2008. So I'm going to go with what happened in between 2008 and 2014. The value
Right.
of the stock market in the world doubled in size. Something people don't talk about, but it did. So I'm going to make an assumption that this what happened in February pressed the reset button based on the actions of the Fed and the central banks.
Sure. So in the context of the global economic crisis that might actually materialize or solidify and strengthen in 2021, assuming we do come out of the pandemic, is there a sort of a sentiment among larger portfolio advisors that a more defensive position might be recommended, i.e. US bonds and or precious metals?
Look, I talk to a lot of hedge fund guys, and every one of them is talking US dollar, by the way, gold, and the bond market. Every one of them. Not so much the bond market, at least for the foreseeable future, but definitely gold and without a question, the gold market in US dollars. As a matter of fact, a lot of the guys I'm talking to are becoming a lot more bullish on the US dollar in the short term, which is kind of odd if you consider where we are in the economy right now. I mean, there's really no fundamental reason for the US dollar to strengthen right now.
Right.
So yes, I am seeing it. I'm seeing more gold. I'm seeing gold, US dollar, bonds in terms of how much what traders are seeking on. But I think you would have to be nuts as a professional trader not to put some assets into gold or the bond market or the US dollar right now. I think you would have to be loony. I think your license to trade should be taken away if there's such thing. As I'm talking about from a portfolio management perspective. You need those assets in your portfolio right now, especially with what's going on in the stock market. And by the way, I think that the run in the gold market is not over yet. I think we're going to see more upside. I think it's just going to be after the election. I think that the election is extremely bipolar, and I think the metals are very sensitive to economic policy changes. They've been historically. So I'm not surprised with what I'm seeing, but I'm not giving up the bull run just quite yet.
Sure. Are there any stocks specifically that you've got your eye on immediately post-election result that you think will have a good chance of appreciation regardless of who wins? And are you watching any that are more candidate specific?
To be quite honest with you, as far as candidate specific, my eyes are on the Russell versus the S&P. And I've mentioned this, Russell stocks are a lot more vulnerable to Trump than they are towards Biden. If Biden wins, there's probably still a good 12 to 15% inflation, artificial inflation that needs to happen in those stocks before they're at fair value. So if you're looking to take advantage of Biden in a very clean and easy, simple way, that's a nice whole market approach. Otherwise, a Biden win would be very good for alternate energy stocks and possibly pot stocks. A Trump win would be good for oil companies, or better for oil companies or traditional energy companies, and it would be better for infrastructural stocks. So, but in terms of what I have my eyes on right now, I'll tell you a trade that I have my eyes on right now. It's a very interesting trade, and I think again, my consensus, James, is that the presidential election and the outcome of the election is going to have a lot less impact on the economy because of what happened already in February. I think that that movie is playing and it's superseding everything else. Because look, let's say for example, Biden wins and he does something, and then again we have a stay-at-home economy. We've all seen that the president's power in going against the virus is extremely limited. So I think, in my opinion, the virus, this COVID-19 and the recovery, and I think all of that the stage has been set. The players are in place. I think we're at a point right now where maybe if the election was around March, things could have been changed, but I think we're far ahead. So, and Jeff Zanninari says the same thing. We may have a little ripples after the election, but the market is set to do a certain thing. And I think those cards have been already dealt in February. But let me tell you and our readers what I'm looking at. I gave this trade out earlier this week. This is a longer term trade. I think it'll play out regardless of how things will go. And it's based on fundamentals and technicals. I think consumer credit, James, is going to recover a lot better than institutional or commercial credit. I think commercial credit, when you think about it, businesses are slower. People are not flying. Business travel represents a huge segment of the population. People are not flying right now. So I think it's very fair to say that irrespective of who wins the election, that the recovery in business credit will take longer than consumer credit. Okay. So also, if you look at relative strength, and I did this earlier this week, so don't quote me on these levels, but I'm pretty sure they're still holding. Discover Card, DFS ticker symbol, Discover Card, was in the top 10% of the S&P 500 relative strength. And the stock was looking really good. Now, last I heard, Discover only deals with consumers. Discover Card is fairly against businesses. They're not a business-friendly environment. Whereas American Express has a huge exposure to the business world. And in addition to that, think about all the travel, business spending, you got the commercial credits. A lot of businesses rely on American Express. Also, American Express is not a traditional multi-month payment system. You got to pay off things right away. And as we know, it's not a really great time for businesses right now. And it's not a really great time for travel right now. And it's not a great time for entertainment right now. And I just named 80% of what American Express does. So right. Their relative strength right now out of the 500 stock, they were on the bottom of the third page. They were near the 400th, 350, 400th, whereas Discover was above the 50th. So I'm going to go long. And their volatility, by the way, was about literally, I think American Express volatility was 10% higher, 5% higher. So you could literally create a spread where you would buy Discover and you would sell American Express. And I really like that trade right now.
That's a great update as per usual. We're going to leave it there for now. I thank you for your time, and I look forward to speaking to you again next week. Have a great week.
Thank you, James. Thank you. Have a great weekend. Thanks for having me. Bye.